Stanley Druckenmiller, the greatest investors make large concentrated bets where they have a lot of conviction. And one of the really interesting things about this guy is that he's probably one of the best investors ever. I hadn't really heard of him, but my friend who used to work in Wall Street was like, dude, 20 years ago, everybody looked up to this guy as like a legend. So they all listened to him, they all respected him, and he knew what was up because he's been in the market so long. But check it out. It says he dropped out of a PhD program and joined the Pittsburgh National Bank as a retail investment analyst. Let me zoom in on this a bit for you guys. After learning the ropes, Druckenmiller founded his own investment firm in 1981, Duquesne Capital Management. He established such a strong track record that hedge fund legend George Soros recruited him to work at the Quantum Fund, which he did from 1988 to 2000. As the Quantum Fund's lead portfolio manager, Druckenmiller helped Soros pull off one of the single greatest trades. In 1992, the pair broke the Bank of England with a bet against the British pound that netted a $1 billion payday. Following his long partnership with Soros, Druckenmiller built Duquesne Capital to a peak of $12 billion of assets under management. In 2010, he returned all of his investors' money and converted Duquesne into a family office. It goes on to say that basically this guy was like 30 years in a row, 30% return on his investment, and that fades anybody ever, as far as I know. Warren Buffett, I think, had 20 years of 20%. This guy had 30 years in a row of 30%. So when he speaks, you listen. He's actually been on CNBC recently. I could maybe pull up a video and we could watch that together later. But this article is really interesting because they grill him on a bunch of stuff that's happening like right now, like Bitcoin. What do you think about the Fed's moves? What do you think about all these different things? And so we can go through that together. Yeah, so I left off a minute ago saying that in 2010, he shut down his fund and just made it a family office. And a family office is basically like a private hedge fund where you're managing your friends and family's money. And the rules are very different from hedge funds, and the reporting requirements are very different. And so he didn't want to, it says he didn't want to deal with the stress of it. And the record is almost peerless. Over more than 4 decades of investing, Druckenmiller has never recorded a down year. His fund even notched a return of 11% in 2008, which was like super dumpster fire year. During one stretch, he compounded assets at 30% plus a year for 30 years straight. Today, he has a net worth of more than $5 billion, which is super wow. I don't know anybody else who's like that. So I wanted to skip down to some of the other sections. When they were discussing the parallels between the recent tech sell-off and the dot-com bubble. The long and the short of it is, like the dot-com bubble, current tech valuations are speculative. However, Druckenmiller believes today's high-growth tech stocks, particularly those involved with digital transformation, like example of cloud stocks, will be able to grow into these valuations within 3 to 4 years. So he's saying, I don't know, Zoom or something like that, which exploded massively, and everybody's like, oh my gosh, Zoom's super amazing, and it made a lot of money. He's saying, probably he's not talking about Zoom. He's probably talking about more speculative things that haven't actually, started making significant money yet. Zoom was maybe a bad example, but he's saying, yeah, they're growing so quickly that the current valuation, the current stock prices are valid in 3 to 4 years, if they can keep going for that long. So he's saying it's not like an over bubble where it's just like, it will never actually be worth that much kind of thing. Another example, people often ask me about this because I'm streaming from Japan. What about the Japanese, economic miracle and bubble that burst subsequently? One of the insane parts of that bubble, people often cite, dude, this is just like Japan. We're going just down the road. Japan went down and they still haven't recovered. The Japanese stock market has just been flat for 30 years. But the Japanese stock market bubble was so hyper ultra bonkers. Like we look at, stocks like Palantir or Snowflake and people are like, oh my gosh, the PE ratios are ridiculous. The EV EBITDA is ridiculous. This is such a bubble. Oh my gosh. But the Emperor's Palace in Tokyo is like a few blocks. It's a few square blocks. It's like, I don't know, something like a couple hundred acres. And yeah, it's in downtown Tokyo and it's an amazing place. But that little grounds was worth more than something like New York City. Like the entire worth of New York City. Like that's how insane the bubble was in the late 80s in Japan. So they're asking him, what do you think about this, the parallels between the tech sell-off and the dot-com bubble? Druckenmiller says, I'm seeing some similarities and I'm seeing some differences with tech stocks today and during the dot-com bubble at the turn of the century. Number one, valuations in both periods go to what I would call speculative levels. And he goes on to talk about how monetary policy was part of the issue. And then in this paragraph, it's nothing like the crazy stuff we're seeing now, though. But that helps set it up for what was going on what was going on back then. He goes on to talk about what it was like at the time. When you're building the railroad, your sales are going up 50, 60, 70% a year. But once the railroad is built, you don't need the railway ties anymore, like the pieces to build the railway. Your growth not only doesn't go up 70%, it goes down because on a rate of change basis, you don't need any more railroad ties. And that was the problem during the dot-com bubble. So none of us, me included, saw that in early 2000. A lot of these companies with estimates of 50 to 70% growth for the next 2 or 3 years had businesses that were literally about to collapse. So the NASDAQ went down 95%, not 30%, but 95%, because you had this combination of inflated values, way overestimated earnings, and then an earnings collapse. I wonder, like, as I'm reading that, it kind of reminded me of the NVIDIA video I put out the other day, where it's like forward estimates for the next couple of years are like negative 40% EV EBITDA growth and stuff like that. I was like, kind of reminds me of that. I'm not saying NVIDIA is going to, shrink or fall apart or anything bonkers like that. Just kind of remind me of it. So he's saying today you have something similar and something different. Monetary policy is absolutely insane. We have no quantitative easing. We had no quantitative easing back then, and our interest rates weren't 0%; they were 4 or 5%, and they probably should have been 6 or 7%. So we have an asset bubble now. That's not just in tech stocks; it's in everything. I kind of know the young backers of DogeCoin might agree. If you're an asset, you've been moving. From 1995 to 2000, you had an incredible wave while the internet was being built. What you have now is this incredible wave of digital transformation, particularly moving on to the cloud. I used to say 2 to 3 years ago in some interviews that we're in the bottom of the first or second inning in terms of digital transformation, and this is a 10-year runway. Well, COVID sort of jumped you from the bottom of the first inning to the sixth inning. I think Shopify CEO Toby Lutke said we went from 2019 to 2030 in terms of e-commerce sales in 1 year. So COVID fast forwarded everything as far as digital transformation. And I think the difference now is that if you haven't moved to the cloud, you're dead, because who you're competing against, they can just beat you because technology is so important. So now, full disclosure, I didn't see what was coming in 2000, but I have a difficult time coming up with a scenario that this digital transformation thing is going to collapse and these SaaS companies are going to go away. So he's saying it's not going to collapse like how it did back then. The biggest problem you have is the overall bubble in asset prices. The good news is, if we had this conversation 2 months ago, the good SaaS stocks were like 45 to 50x sales. Not earnings, but sales. They're down to, there's a range, I'd say now 10 to 25x sales for the good ones. So he's saying valuations have actually like slowed down, settled down a little bit to more rational valuations. So if the problem is price, and in my opinion, that is the problem, a lot of that has been wrung out. And I think if you hold these names for 3 to 4 years, they could easily grow into their valuations. In comparison, if you held the names in 2000, a lot of these companies, you still would have lost 90% of your value, right? So those are the similarities and those are the differences. What do you guys think about that? He's saying basically, compared to 2000, we're not really looking at a bubble. We're not really looking at a dangerous situation, so to speak, especially in tech. And then he goes on to say, and I'll get into it in a minute here, how the big stocks like FANG or FAMG, whatever you want to call it nowadays, they're like fine valuations. There's nothing alarming about them. Whereas in 2000 or in the dot-com bubble, it was like everything was super obnoxiously overpriced.